And we're going to continue with accounting concepts and principles. This is very important because I think that once you, beyond just looking at the product of accounting, it's really interesting and useful how everything is looked at and how everything is structured. This is like the structure of how accounting is done to begin with and why it's done, as opposed to what we're looking at the financial statements is the product of all those applications. So this is actually very, very good to know. Accounting entity. So by definition, whenever we talk about accounting, it's related to an entity. And that's why every separate entity will have its own accounting, its own year end, and its own beginning and end. So it's really good to know, because once there's a lot of related parties, you'll know, okay, we got to do it by entity. That's how everything starts. Going concern, accounting is always looked at from a perspective of like what's going on now, what's going to happen in the future. And basically, we are aware that the entity is not going to be liquidated, that the entity will continue to operate as is. And if not, then we have to disclose it. Unit of measurement, we're basically using a dollar. Once cross-currency things come up, it's very different. Cost principle, transactions are recorded at the original cost to the entity as measured in dollars. So basically, this is a key concept that says basically cost is recorded at purchase price. Objectivity, the accountant's desire to have given transaction recorded in the same way in all situations. So objectivity, this is going to be a huge topic all in itself, and I would like to develop it. This is something that means that the accountant has no vested interest in influencing the transaction in a certain way. And I remember I used to be an auditor at Ernst & Young for many years, and the firm used so many resources to achieve what they called independence, which means that they basically are not connected to their clients. And for an individual, you have to remain objective so that you don't have influence on the transactions. And you'll see it in practice, it's very easy to change a transaction slightly because of vested interest, and this skews the whole process. Accounting period, everything in accounting relates to a period. Everything has either a statement of operations, a gap of time, or a statement of financial position has as of date. So it's like a snapshot, as the other one is covers a period of time. The matching concept basically wants to match uses of resources with expenses, with revenues of resources. So it's kind of like whatever you're using has to be matched up with whatever you're generating. And that's the matching principle. It kind of starts creating an atmosphere of cause and effect and of comparative periods as well. Accrual accounting means that you recognize revenue whenever you realize that it will be coming in for sure, and you recognize expenses when you realize the expenditures will occur for sure. Consistency means that you apply all your methods consistency to everything across the board. Full disclosure means that you're disclosing everything that is possibly useful to investors and everything that is material. In other words, anything that could influence one's decision about the financial performance of this company or the valuation even of this company must be disclosed because it is material to the investor's investment. Materiality means the benefit of increased accuracy should outweigh the cost of achieving the increased accuracy. Basically saying that whatever you end up going after in terms of achieving a certain additional accuracy, additional disclosure, additional organization financially should outweigh the cost of that. And in other words, this is how to deploy your own accounting resources to achieve accounting objectives. Conservatism means that basically when in doubt, make judgments and estimates that result in lower profits and asset valuations. This is a general guideline that basically says accounting is not something where you need to be aggressive in terms of higher profits, higher values, and it's better to go the middle way or even go lower estimation if it involves estimates, because once estimates change, it could be more confusing and more risks or even liability to basically overestimate profits, overestimate assets, and then have them come down and then have the negative effects of that, then be in the middle or low, and maybe you missed it and profits were a little higher or assets were a little higher and you just adjust in the next period.